Leveraged ETFs are some of the most riskiest ETFs that you can buy as a trader or an investor. The reason being is because they magnify your losses or gains, which means that you can make or lose a ton of money in a very short period of time. Hey guys, my name is Faizy and this channel is about finance and investing, and today we're talking about two main ETFs, TQQQ and SQQQ. From now on, we'll refer to these as TQ and SQ to make it easier. Before we begin, this video is not financial advice. I'm not a financial advisor. We're speaking in a very general sense only. I just have a passion for finance and investing, same as you. So always make sure to do your own research. Let's get into it. So let's now look at what a leveraged ETF actually is. So we know that traditionally speaking, a normal ETF tracks an index and they go up and down depending on how the index is doing. However, with leveraged ETFs, the fund managers use derivatives, debt, and other instruments to magnify your return by 2 to 1 or 3 to 1. So what does that mean exactly? Let's have a look at an example from the Nasdaq 100 ETF. So if the Nasdaq 100 was to go up by 2% in any given day, a normal ETF like QQQ will track that and also increase by roughly the same amount. But the leverage version of QQQ, which is TQ, this will increase by 6% in a single day, because this ETF aims to give a daily return of 3 times whatever the Nasdaq 100 ETF is doing. Now that may sound super exciting because you are getting crazy magnified returns, but on the flip side, if the Nasdaq 100 index was to fall by 5%, which has actually happened quite a few times in the past by the way, this ETF will plummet 15% in a single day. So this product is very volatile to say the least. I've read somewhere that they made an ETF like this especially for traders, for them to find more creative and fun ways to make money on Wall Street. So there you go. Now if we have a look at TQ's returns over the past, they're actually pretty phenomenal. In fact, the returns are better than most ETFs out there. If we look at the 1-year return, it is sitting at about 385%. The 5-year return is a massive 880%. Now, if we compare that to the Nasdaq 100 index, the 1-year return for the Nasdaq is 83%, and the 5-year return is 182%. So you would have made a lot of money to say the least. But let me give you guys a word of caution, because this sort of ETF is not to be held for the long term. In fact, it's for short-term holds only, because it's just the way that it's designed. If the market is trading sideways, holding this ETF through all of that volatility will give you results which are significantly different from the 3 times return of the Nasdaq 100. Now we can see this play out in the previous example where the Nasdaq 100's 1-year return was 83%, but TQ's 1-year return was 385%. Now if we look at a different example with the recent sell-off that we saw, the 1-month return for the Nasdaq 100 was minus 2.7%, but the 1-month return for TQ was minus 10.6%, which is nearly 4 times lower than what the index did, not 3 times. So because the market was trading sideways, there were lots of ups and downs along the way, therefore the return was no longer 3 times. Now you can always do a quick calculation on Excel if you're that interested. For example, if you get a price of $100 and you increase it by 3%, then you decrease it by 3% and you do this 10 times, versus if you get $100 once again and you increase it by 9%, then you decrease it again by 9% and you do that 10 times as well, you will find that if you compare the two numbers, it's going to be pretty different, and this is why this leveraged ETF can have such vastly different returns over time. The other reason why you might not want to hold this ETF for the long term is that it's super volatile, and if you're a new investor just starting out in the markets, it's going to be super hard for you to actually cope with the volatility. For this leveraged ETF, it is very, very common to see price upwards and downward swings of double digits. So having that risk appetite is super important. Now, if you bought this ETF last year before the March sell-off that we saw, this ETF would have lost 70% of its value. So during that time, it would have been super hard for you to not sell and just get your money back. Now we can look at all these graphs and look at things in hindsight and think to ourselves that we could be very good investors when that time actually would have happened. But in that exact moment when things aren't going too well, it's very hard to actually see the clear picture. Now, the last reason I'm going to give you for you to not hold this ETF for the long term is the fact that the expense ratio is just way too much. Currently, if you have a look on their website, the expense ratio is 0.95%, which is ridiculously high. So over the long term, this is going to erode your returns. The other very cool but risky fact is that your investment can literally go to zero. Yes, zero. Your hard-earned money basically getting disappeared. Now, if the Nasdaq 100 index was to fall 33% in a single day, which is a very unlikely scenario, since this ETF is tracking 3 times the daily return for the Nasdaq 100, it can go to zero in that scenario, and you can actually see this on their website as well, on their prospectus. They are literally saying that your investment can result in a total loss right here. Now guys, if you are finding value so far, please leave a like and subscribe. It really helps out with the YouTube algorithm. Now similarly, SQ is the opposite version of TQ. It's an inverse leveraged ETF, which means that if the Nasdaq 100 goes up, this ETF will fall in value by 3 times, and vice versa. So as you guys can see, this ETF started out at a value of nearly $100,000 in the beginning, and it's been falling since because the market has been going up over time. And since it's leveraged at 3 times, this means that this ETF will replicate the returns of the Nasdaq 100 in an opposite manner. So if you guys have a look when the March sell-off happened, this ETF increased quite nicely. But once again, if you try to time it, it's very risky because you're essentially betting against the market, and if you buy at the wrong time, you can get pretty burned. Now this actually happened to me, not in the March sell-off, but in the more recent correction that we had last year around early September to November period. I bought SQ because there was so much uncertainty in the market at the time. COVID cases started to go up and the markets were falling, and I thought this might be a good chance to profit out of all this and make some quick money. However, I bought at the wrong time and I kept holding on, and the ETF kept falling in value every single day, which was so scary, but I was able to get out when the price went back up just a little. And in the end, I only lost a couple of $100, but I learned a very important lesson. Now with ETFs like this, it's probably the best option to do short-term plays because we know that the market goes up in the long run, so we do not want to get caught out. Now, these leverage products are ultimately designed for quick, short-term traders who want to make fast money, and if you don't have the experience or if you're a beginner, it's best to stay away and not trade these altogether. Now both SQ and TQ are ETFs which trade on the Nasdaq, so to buy this you'll need to use a broker that has American stocks. Personally, I use Stake and that works fine for me. There's an affiliate link in description where you can get 1 free stock, and I'll get a free stock as well for signing up once you deposit money in the first 24 hours. Now, the final thing that I will say when it comes to these leveraged ETFs is that there are similar ETFs that are domiciled here in Australia, like ASX BBUS. This is similar to SQ and it's by BetaShares. This ETF will go down between 2 to 2.75% when the S&P 500 goes up by 1%. And the other ETF we have is LNAS. This ETF is by ETF Securities, and when the Nasdaq 100 goes up by 1%, this will also go up by 2 to 2.75%, and it's similar to TQ. Now, if you're interested in learning more about some different ETFs, this video goes into some of the worst ETFs on the ASX right now. All of these ETFs have negative returns, and you can watch this video to potentially find some opportunities. And this video explores the top 4 Asian ETFs to diversify your portfolio in the fast-growing regions of Asia. Thanks for watching, guys. Please like and subscribe, and I'll see you in the next one. Bye now. Now both ETF